Three big value companies we're talking about right now. AMN is our first one. They do workforce staffing solutions in the healthcare industry. Do about $3 billion in revenue. The revenue mix is getting more diversified, which is good news. The United States is getting older, and we're going to need more healthcare workers, which is incredibly depressing. But they are the company with the solution. This company does have quite a bit of market share as well. That being said, the revenue is decreasing for, I think, reasonable reasons. 2020 to 2022 was a very interesting time in the United States. We needed a lot of healthcare workers, and so a lot of these healthcare companies started to boom under this regime. And so as a lot of that spending started to go away, we sort of saw the general collapse of a lot of that spending. However, it is important to note that the spending, $3.2 billion, is still higher than it was pre-COVID, so the company is still growing, despite the fact that a lot of the COVID money has gone away. And as a result, this company is becoming more and more streamlined. Unfortunately, there is one small little detail here. Net leverage, they are increasing debt. Their debt is very long-term debt, so not for a couple of years. So they might be able to refinance some of this stuff in the future, but net leverage is something to pay attention to. I think it's a little bit of a problem, certainly, especially considering they don't have a ton of cash. Levered 3-to-1, generally not an incredibly bad thing, especially with the incredibly high cash flows that this company has. I think it's something to certainly keep an eye on, and as long as it doesn't get incredibly out of control, it's probably not something to worry too much about. Solid company, good financials, operates in an area that has been beaten up for obvious reasons, but is a strong sort of out-of-the-way company that is worth looking into. So with that said, we're moving on to number 2, talking about Vail Resorts. Vail Resorts operates, they own and operate resorts, shockingly enough. California to New York. They own all sorts of stuff, and Australia and Europe. So they're an international company with revenue all over the world. They have a global network of 42 owned and operated mountain resorts with top brands and over 2 million pass holders. And they mentioned that no new ski resorts of scale have been built over the last 40 years. Future growth in skiing and riding will happen in existing resorts, and this is a company that owns some of the largest assets in that space. 10-year compound annual growth rate is 8% on the resorts and 10% on free cash flow. So not only over the last 10 years, they've been able to consistently grow revenue about 8% per year, and they've been able to optimize the resorts to increase the amount of free cash flow that they generate from those resorts. A very big green flag for companies is to see them posting very long time period charts. This is very important. This is, I think, something that gets glossed over a lot. If a company's like, here's what we've been doing over the last 10 years, and here's what we think we'll do over the next 10 years, that is incredibly good to see, because that is an example of management thinking long term. You don't want to see management thinking short term. If you're like, we're just trying to get quarter to quarter, like NVIDIA right now, they're like quarter to quarter, quarter to quarter, maybe even year to year, maybe at the max. But when you see a company like Canon talked about this, right? Canon, the excellent global corporation plan, is currently in phase 6, but this was a global turnaround plan implemented in 1996. When you see management taking this sort of super long-term approach to things, it's kind of a good thing. 5% dividend yield, and they've bought back about $1 billion worth of shares over the last 10 years, which is very good to see. High free cash flow that's growing consistently and over time. Management is taking a long-term approach to investing in their resorts. Overall, very good value. 16% compound annual growth rate from 2008. You want to talk about taking a long-term view of things? This company is taking a long-term view of things. And almost 75% of visits are in the subscription model. This subscription model becoming the vast majority of revenue. And that's what's powering the growth of the company over the next couple of years. As revenue continues to grow, they're continuing to bring people into this subscription model, and revenue becomes even more durable. Grew from 10 to 42 owned resorts over the last 10 years. So this is a growth by acquisition company. Also, another thing you want to see a company doing, $100 million in cost cutting. They want to keep costs under control, and they want to continue to be able to grow that gross margin and that net margin so that they can continue to increase their dividends, so that they can continue to buy back shares, and they want to do this over, obviously, a very long time period. They bought a lot of these resorts between 2016 to 2020. Again, another thing that is something to keep in mind. This company makes a lot of acquisitions, and therefore they have a lot of debt. But this debt is under control for now, and it doesn't appear as though it is getting out of control anytime soon. But at the same time, this is a high cash flow business. I would be weary of them moving forward with more acquisitions. If they continue to make acquisitions without significantly scaling down their debt, I'd begin to question parts of the leadership model here. But high margin, growing business, no signs of slowing down anytime soon, cutting costs. I think it's worth looking into. And finally, for our last but not least, our third business. Silvercrest Asset Management, a company that I have loved for many years, but I've never invested in. Silvercrest Asset Management is a very simple business to understand. Basically, it is an investment company. They help ultra high net worth individuals invest their money, and that's basically it. They charge fees, and then they collect commissions based off of their performance. Pretty simple. They have $37 billion in assets under management. They have a 98% client retention rate, which is incredible, and they've been around for 20 years. They serve individuals, obviously, high net worth individuals, institutional investors, and then they also help out endowments and foundations invest their money. They put out a lot of research as well, which I think is very compelling. Even if you don't end up investing in the company, even if you don't care about the company at all, it's worth going on to their website just to read their research. So like they talk about small caps here. They talk about small caps over the last like 20 years. Is it worth investing in now? You see massive drawdowns. We think that investing in small caps is maybe the future right now. Just absolutely fascinating stuff. It is important to recognize, however, that this is a very slow growing company. This is a company whose primary business model is based off of attracting clients and then collecting management and advisory fees from those clients. So this is not a high growth business. This is a very low growth, slow growth kind of a business. It's been consistent over the last very long amount of time. Over the last 20 years, they've been able to grow their assets. They've attracted $38 billion in assets under management over the last 23 years they've been around. It's very hard to get $38 billion in assets under management, let me tell you. Not that I know, but this is a consistently growing business. It is, however, very low growth. You're only going to see between 2 and 3% growth. Family Office Services is kind of the growth engine for the company. If you do want something that is growing very quickly, over the last 12 years, they've grown their dividend for the last 12 years. Their dividend yield is almost 6%, so you're collecting a lot of money for holding onto this very slow growth company, getting rewarded quite handsomely, I think. The only problem is they do have a 90% payout ratio. So how much longer that dividend can continue to grow, who knows? This is a company that has gotten beaten up over the last couple of years for their incredibly slow growth. It is worth noting that the stock has fallen 40% since 2022. Although, going back to what we said earlier in the video, if you want to talk about Aya Healthcare is a company that peaked in 2022 as well because of healthcare spending. And you could very easily make the same exact argument for ultra high net worth individuals and stocks. Stocks performed very well in 2022 and 2021, coming obviously off of COVID and unlimited money in the economy. Now that we've sort of come off of that high, the company is still continuing to grow past that, but is not growing nearly as quickly as compared to those years. Although I would want to own this probably for the next like 20 years. And those are my top 3 value stocks that I think are worth taking a look at. If you enjoyed, like, subscribe, and come hang out live. Link in the description.